And today is April 28th. It is 9 a.m. in Chicago, Illinois, where I live. My name is Steve Misic. I'm one of the instructors for the Online Trading Academy. And of course, you're all familiar with Sam Seiden as a presenter here, the Director of Education for the Online Trading Academy. I'm one of Sam's personal mentoring students from Chicago. I've known Sam for quite a few years, and I'm at the Online Trading Academy as an instructor, working with Sam. Okay. And what I've been doing here now for the last few months, ever since FX Street was kind enough to ask me to come on and do some webinars for him, what I've been doing basically is using the last 4 times that I've been here to review what I call the market cycle for the currency pair, the spot currency pair, the dollar versus the Japanese yen. And the dollar versus the Japanese yen, obviously, the reason I picked the dollar versus the Japanese yen is because I, of course, live in the USA. There's been other currencies that have been trading against the Japanese yen that have done very, very well, have trended very, very strongly. But the dollar's done very well. It's had about a 39% rally from the lows back in around April of 2012 to the most recent highs at the beginning of this year in January of 2014. So we went from about 75 against the Japanese yen all the way up to approximately 105, where we've currently stalled out and we've put in a little bit of a short-term top. So at the end of the last webinar, which was where we left off was around June of 2013, something kind of really important was happening at that time in Japan. We had just a really, really ugly 20+% drop in the Nikkei 225, which is the Japanese stock market. And the fall in the Japanese stock market meant that most of the traders were covering their short positions in the Japanese yen, and it caused a almost 10% drop. As you can see on this picture, you should be looking at a picture from June 13th and 14th on the daily chart of the dollar versus the yen, and it caused almost a, I would say, 10% drop in the dollar versus the Japanese yen at that point. And that was just about the time that our dollar versus the Japanese yen was about to hit a demand zone on the weekly chart, which is what it ended up doing. And when it did hit that demand zone on the weekly chart, that's when the dollar versus the Japanese yen began to bounce. So I have some pictures here. This is the weekly chart of the dollar versus the Japanese yen, and the date on that picture was actually 6/12. And we were just about to hit the area of demand on the weekly chart at around 94.43. And what's really important about what we believe as far as trends go is that the market really only goes up, down, or sideways. Okay. And by that, we mean that sometimes the market's trending up, as it was prior to actually topping out at that point in time at around 102, 102.5. And why is there demand here is a question I'm seeing in the chat. And the answer is because prices went sideways for a period of time in March of 2013, and then they rallied out of there very, very strongly. And so why there's demand here is because at the origin of where that rally is, we know 2 things for sure. Number one, there are no more sell orders at that price level of 94.43. If there were sell orders, price never would rally away from there. So the first observation is prices rallied away from there because there were no more sell orders at that price, and price will go higher looking for more sell orders. And the second observation is at the origin of that rally is probably where institutions had unfilled orders to buy the dollar versus the Japanese yen. So that pattern that we're looking at, this little basing before this rally, which actually went to the highs of the year at that time, is what creates a pattern we call demand. All right. Now, we could call it support, and I'm sure you've listened to webinars, and you listen to webinars all the time with people that come on and talk about different types of support. But what we teach at the Online Trading Academy is that institutions have large orders to buy at the origin of that large rally, unfilled orders to buy. And as you can see, before we move on, I have a little area here at around 100.29, which I've marked off as supply at that point. So in other words, if I was going to take a trade right now, I would buy at 94.43 and I would place a protective stop below 92.67. And my target would be 100.29. And that would allow me to measure how much risk I'm willing to take on the trade and what my potential reward is on the trade. And that's how you actually would plan out a trade using the methodology that we teach. The other most important thing is that demand level that you see at 94 and that supply level that you see at 100. At this point, I expect that to contain price until either the demand is absorbed and then will drop down to the 86 level I have marked down at a lower price, or the supply is absorbed and then will rally to the 105 level that I have marked off above the supply level that you see. And I don't know which way it's going to go. They don't give me the heads up. I just know that if I wanted to buy, I would buy at demand. And if I wanted to sell, I would sell at supply. So what ended up happening was price did come down to the weekly demand level, didn't quite make it to the daily. And there's a 200 moving average here on my daily chart. So there may have been some people that were buying at the 200 moving average, because there are people that use that for analysis. They buy at moving averages. And 200 is kind of an important moving average. But we're buying because of the demand zone, and we're not really concerned with the moving average. So what ends up happening is price stays around this area for a few days that week, and then it begins to rally away on around the 19th. And then it has a really strong rally on the 20th, all right? So this means that prices bounced off of our weekly demand level, and it's now heading up to daily supply. And daily supply comes in between 97.81 and 99.50. So we have some supply in the area between 97.81 and 99.50. And again, it's our belief that institutions move prices down to where they have orders to buy, and they move prices up until they find orders to sell. So because of this strong drop here, we believe that when we get to this 97 area, we're probably going to find some sellers. So this is what the weekly chart is starting to look like now. Pretty strong rally. And then we come up into this 97.80 area, and for 2 days or so, we definitely have some sellers. And if we didn't have sellers at this price level, then price would continue to rally higher. The only reason that price is stopping here is because there's definitely buyers, but now they've run into at least a fair amount of sellers, at least enough to slow down the buying. And now it's just a matter of, do we use up all of the sell orders? Then we'll go higher and we'll come up to the next area of supply above current price. But if we don't use up all those orders, then we'll fall from that area. So here we are on the 22nd. And now the weekly candle has managed to rally almost all the way back to the prior highs of the previous week. And then we get a little bit of selling on the week starting on the 24th. And that means on the daily chart, we'll have a little selling too. And we have a little bit more selling on that date, the 26th, again on the weekly chart. And as you can see on our daily chart here on the 26th, same date, we've now gone sideways in this area that I've marked off as supply for 1, 2, 3, 4, 5 days. And at that point in time, again, if you take out all the sell orders, you'll rally through. But if you don't, you'll start to fall. And if you fall, you'll probably fall at least until you run into a good area of demand below current price. And of course, that area near 93 is actually the best area of demand on this chart. But let's see what happens for the next few days. Prices rally through the supply level after about a week. And so now they've rallied through this first supply level at around 97.86. And they're coming up to the area at 99.50 next. And of course, based on the way we've taken all that time to base here and prices have rallied away, there's now possibly some buyers, willing buyers at this 97.86 area. But of course, now this means that the range on the dollar versus the yen is probably going to get a lot smaller because the seller orders are near 99.50 and the buy orders are near 97.86. So at that point, anybody that's looking to buy possibly might look to buy if price comes down to this 97 area, 97.83. And of course, they can use this 99.50 area if they're looking to sell as a possible area to go short. Now, depending on your style of trading, and there's all different kinds of styles, there's people that like to trade for intraday trading, and there's people that like to trade for longer term. Anybody that bought down here in this weekly demand zone would be probably just using this 99.50 area as a potential price target. And if they did, that's fine. They could trail their stop loss on that trade so that they could lock in profits. So somebody that likes to hold for more than one day, that doesn't mind holding overnight for whatever reason, what they could end up doing is using these old supply levels from the sell-off that we had as potential targets. But anybody that's looking for a trade that day, even though the dollar versus the yen had been trending higher for the past couple of weeks, you've got to be careful that if you buy in an area where prices have fallen as sharply as they have over here. So we would tell our students, don't look to buy into supply. You could look to possibly shorten the supply level, and you could use this opposing demand level as a target, provided the amount of risk you took on the trade fits your trading plan. So what ends up happening is this price now works its way up to where the weekly supply level is. So it's definitely inside of that daily level. And it's now pushing into the weekly level, which is between 100 and 101.74. So it makes it past this first daily supply level. So anybody that's long now from the lower price, which you probably would want to trail your stop loss now, and that would be one of those times if you didn't have any other place to put your stop loss, you could definitely use your, I've got a 10-period moving average here, which would be a trailing stop. Because that's a very strong short covering rally that we've had now for the last 3 weeks. And we're now into the first week of July. And we're in that weekly supply level now. But once again, now the daily supply levels are definitely going to hold price back for a certain period of time. The weekly supply levels generally will hold price back for even longer periods of time. And we've just entered this weekly supply level on the week of 7/7. And we've had a little bit of a reaction that day on 7/7. We've had a pretty decent sell-off. And on that day, that's about 100 pip sell-off. So anybody that was long, if your stop loss is below your 10-period moving average, so far so good. But anybody that was looking possibly for a shorting opportunity for an intraday trade, you have to take your profits on that, because at this point, the currency is trending higher. So if you are shorting, you are trading against the trend at that time. So here we are. The week now, it's 7/10. So it's the new week. And we've got a weekly candle that just starts to form inside of our weekly supply level. And what I'll do is occasionally, all right, so the week of 7/10, which was the week that we were talking about, this is my blog. And again, on my blog, which is only open to Online Trading Academy students, and it's open to students that are actually trading multiple assets. What I do every week is I do my blog, and I do it on the same 7 assets that I have been doing for the last almost 2.5 years. I do it on the large cap U.S. stock market, and I do it on the Indian Nifty market for the Indian students. I do it on the bond market. I do it on a commodity market, wheat. I do stocks. I did, up at this time, I was doing a stock called Akamai Technologies. And here was the blog post that I put for the dollar versus the yen that week. And it said that the 8.25% rebound from the June 2013 low in the pair has hit a daily supply zone between 165 and 101.74, which led to a 62 pip pullback today as strong economic data was released in Japan. Strong economic data raises fears that the Bank of Japan may reduce the size of stimulus, which is designed to weaken the yen to boost exports. The strong U.S. dollar is already being blamed as a reason for weaker than expected earnings in the U.S. with U.S. companies that had exposure to the yen. Price is about to test the daily demand zone between 100 and 99.26. And I put on there, this demand zone has poor location due to the supply zone being so close. And if price fell through that demand zone, then the next demand zone would be between 97.82 and 99.69. Price rallies, the next daily supply zone was between 102.46 and 103.73. So whenever we have students, and we do have new students all the time that are coming into the program and they're learning about how to trade using demand and supply, we warn them against buying when demand and supply levels are really, really close to each other, because you don't have room to make a profit. And one of the things you always want to have is some kind of room between the levels that you trade so that you have a chance to make a profit. So what I've done is I've explained to the students that this first level of demand at 100 right here, which is parity, is not the ideal location. And if you were long from lower prices, you actually should be trailing your prices right below 99.26 at this point. And if you were looking for an opportunity to buy, you'd have a much lower risk opportunity to buy at the demand level below that price, which is 97.82. Okay, so when we go back to the actual document that I'm using here, where I keep track of what happens, there's that picture. And what ends up happening is, because we're in a weekly supply zone, that first area of daily demand fails right away. And as a matter of fact, we have two really, really sharp days of declining prices in the dollar versus the yen. And then we have a little snapback right away. So this is now 7-11. So that's one of the reasons why a lot of people will attend a webinar like you're attending right now and figure that, or attend Sam Seiden's webinars and figure that you can use the information to help you trade, which is great. But there's more to it than just as easy as we make it look when we do these webinars. There's quite a lot more to it. So making sure that you're not buying on the wrong end of what we call the curve is very important, because that demand zone being closer to higher time frame supply zone is almost a guarantee that it's not going to work. And of course, we do have new students, and I do my best to try to warn them to stay away from buying demand levels too close to higher time frame supply. So here's the weekly chart now. This is the second week that we've been in the weekly supply level. The first week we rallied in, we had a nice rally up. The second week we've had a big sell-off, and we've actually gone below the week low of the previous week. So for the last 2 weeks now, the ranges are getting a little bigger, and we're in these supply levels. All right. Okay. And prices are attempting once again to try to rally a little bit. Okay. And then this next week, which is now the third week since we've entered the supply level, the week of 7/17, we're falling a little bit. And on the daily chart, we're just trading in a range, mostly between around 98 and about 100 and a half or so. So we're definitely trading sideways in this area. And you'll see the pair do this quite a bit. And then we start to rally back up again, and we're coming back up to the area near 191, almost 102. And when we get back up there, this is now the fourth week that we're in this supply level. And of course, on 7/10, our Federal Reserve had a meeting, and at that meeting, they announced that they would keep interest rates easy. All right. So they're announcing that they would keep monetary policy loose. And of course, that's generally not good for the US dollar. Generally, when our Federal Reserve says that they want to keep interest rate loose, or the Bank of Japan says that they want to keep monetary policy loose, that's generally going to be negative for the currency. So it's another reason why our currency wasn't really rallying at this point, because not only was it in this supply level, but we did have our monetary policy, our Federal Reserve, saying that they wanted to keep monetary policy very loose. So now, price never did come down to the 97 demand zone. And because it rallied away from the area at around 99.60, it once again is an area where there may be some leftover buy orders. And in this case, there were. On 7/24, the price actually fell back down to around 99.50. Now, because I do the blog only once a week, one of the things that the students have to understand is that areas of demand and supply will form as price is moving all the time. So new areas of demand will form if prices rally, and new areas of supply will form if prices fall. So a lot of times what will happen is they'll have to get into looking for those levels on their own until the following week. Okay. So in this case, because prices went sideways for a few days and then they rallied and they went back up and tested the area where the weekly supply was, they made a little bit an area where there were some leftover unfilled institutional buy orders, which caused price to rally a little bit. On the following week, though, now the sellers really started to push the price lower. So we've spent 1, 2, 3, 4. This is now 4 weeks in the area. And on 7/26, the dollar versus the yen is beginning to fall from the area of supply that we've identified. And at that point in time now, we'll probably come lower. And if we do, we'll test the area of demand at around 97.82. And of course, if that area of demand doesn't work, then we'll come all the way back down and we'll retest the lower area of demand near 94.50. So prices are falling for a couple of days, and now we're coming down to the area of demand, and we got very close and we bounced away from it. And this was on 7/27, so we're coming up to the end of July of last year. And we come into that level, and now we're on a daily chart, and it's now 7/31. We've been in this daily level for 3 days. We've gone sideways inside the level for about 3 days. And at this point, we're either going to rally out of the level, and if we do, we're going to run up to this area of supply that formed when we fell at around 99.38. Or once again, we could take out this area of demand. If we fill all these buy orders, we'll end up dropping through the area and we'll head lower once again. So this is the Nikkei itself, the Nikkei 225, and the Nikkei started to rally. Well, whenever the stock market in Japan begins to rally, that's usually going to be when this pair will also rally with it, the dollar versus the yen. So on 8/1, after spending 1, 2, 3, and now 4 days in this area, we start to rally away from the area. We've used up all the sell orders down here. We still have willing buyers, and now we're starting to bounce. And of course, some people would say, well, we're bouncing because the Japanese stock market is bouncing. And of course, I believe that that's going to be the reason that the news says we're bouncing. The reason we're bouncing is because you've used up all those sell orders down there, and there's still willing buyers, and so price is rallying higher. Okay. So when we rally higher, we rally straight up into this area of supply at around 99.38, and we start to go lower the next day. And then we go lower once again on the day after that. And now we're on 8.6. So we've gone right straight up to where the institutions had orders to sell. And we're on our way back to where the institutions have orders to buy. And at that point, we're now starting to fall pretty far and pretty fast away from this weekly supply level. And we're just about in the middle of the range now on this weekly chart between our demand level and our supply level. All right. So on the daily chart, we're pushing through this area of demand. And of course, we teach our students that there's orders here to buy. And each time price comes back, some of those orders are filled. And of course, if price comes back and there's no orders to buy, then price is going to go lower. And then this is one of those cases where the first time we came back here, there were orders to buy. It drove price right up to where the sell orders were. And now the second time we came back to that area. So as I was saying before I got lost, so if there are no more buy orders here, then of course price is going to fall. And because it is coming down to a 200-day moving average, there's a chance that there might be some big institutions that are looking to buy on the test of the 200 moving average. So we'll see what happens. And again, I don't look at this every day, so I really don't remember from one day to the next what's happening. But we did have a nice rally the week of 8/14, so price did fall and actually go below the 200 moving average. And now it went sideways for a few days, and then it began to rally away again. And as we always tell our students, that's the pattern you want to look for. You want to see if prices are dropping, and then all of a sudden they go sideways for a period of time, and then they rally. Then you may have what could be a new demand level. And this one is between 96.70 and 95.80. So we've created a new level of demand on the daily chart, and prices once again rallying back towards the daily supply between 99.38 and 100.40. So we have some sideways trading now the week of 8/20, and we have actually a new little supply level form on the daily chart between 98.08 and 98.64. So when, again, the market rallied and then based and went sideways and dropped, now you've really got a tight range. Now, whenever you see this kind of tight range, this usually leads to several weeks of sideways trading with the pair going nowhere. And there's not really a lot of room to make money in this case, because 96.70 up to 98.08 is not very much room at all, and very difficult to trade when this happens. But it does happen, and it's around that time when currency traders like to take vacations, and when they take their vacations, the ranges will get narrow for a while. Okay, so on this week again, we've got sideways trading. We've moved up to the last week of August. And then all of a sudden we fall once again. And this time we're falling back down to our demand level that formed a few weeks earlier at around 96.70. And now we've got another daily little supply level at about 98.50 up to 99.15. So we managed to push through the 99.08 level after about 4 or 5 days. We rallied higher. And then again, we got close to the weekly supply level and we fell again. So this is one of those times, folks, where if you're somebody that's trading the currency pair when it's going sideways, not very easy to do. We're pushing once again into the weekly supply level, and we're inside of the daily supply level. So we're past this level of supply as well. We're back up into the higher one between 98.30 and 99.38 and 100.40. And now we've created actually a little tiny demand zone too at around 98.30 down to 97.87. So it's looking like the currency wants to trend higher again. And of course, the news at these times is always going to be something that you want to check just in case there's something major in the news happening at that time. So for this particular time, what ended up happening was the market was responding to news that Japan would continue once again to increase the stimulus, and the central banks from all these different countries like to meet, and they like to talk about the directions of interest rates. And so what they'll do is they'll say, we're going to actually raise it, or we're actually going to go and lower interest rates again as much as we can. And actually on 9/3/13, the Nikkei staged a 4.74% rally as the market reacted to the delayed news in the U.S.-led attack on Syria. Again, the Nikkei extended the rally to 11:10, taking out the daily supply levels between 13,887 and 14,084. And the dollar yen, which has been following the Nikkei higher, traded past the 98.49, 99.14 daily supply level and right into the 99.38, 140 supply level where it has been basing for 2 days. The rally created a demand zone between 98.30 and 97.87. There may be option defense barriers near the 100 level. Under normal conditions, the dollar yen should continue to rally, meaning pullbacks to demand are buying opportunities, but panic can cause the market to trade much lower, so use your stops. So once again, I'm pointing out that new demand level that formed at 99.30, and I was also pointing out that the institutions sometimes like to use barriers, option barriers, and they may have some of those barriers near 100 at that point in time. And that'll generally slow the market down and will prevent the market from actually rallying quite a bit higher. We also had the Nikkei pushing through one supply level and working its way towards the higher level at 14,228. So if you look at this chart and you look at the chart of the dollar yen, now you can begin to see that the charts are almost looking identical. Every time the Nikkei comes down to demand, the dollar yen pair will rally, and sometimes the dollar yen pair will stop short of hitting its demand level because the Nikkei hits its demand level. So the correlation between these two currencies is something that I noticed and something that I pay attention to all the time. And I'll kind of keep a chart of both the Nikkei up, and I'll keep a chart of the dollar versus the yen up. And I'll watch to see if those are coming into levels. And for the most part, you'll see pretty much the same picture, and the charts will almost look identical, except for the locations of where the levels are in these charts. All right. So there's the Nikkei rallying up to the next supply level. And the following week, it's now 9:10. And we're back inside the weekly supply level. We start the week inside the zone. And on the daily chart, we move into the zone. We have a little bit of selling. We come back up. We're still inside that zone. So there's still definitely interested sellers in this area. And notice we haven't really managed to advance very far above 100. And of course, if there were option barriers up there, then there would be incentive for anybody that was short those barrier options to kind of keep price from hitting that barrier. And so we'll see a lot of trading in this area. And what happens the following week, we go a little bit higher. And we get up to a little area of supply between 140 and there's another area at 191. So we're into our next areas of supply on the daily chart. We've created another area of demand at around 99.69. But I'm always going to say that if you're thinking of buying this thing on weakness, now you're getting into the area where this demand level usually won't work very much. Okay. What percentage of the correlation between the Nikkei and the dollar-yen pair? Well, I've noticed that they pretty much move in lockstep, actually. So you'll see if you look at the charts, a lot of times they'll both come into supply levels and demand levels at the same time. I started posting regularly on my blog pictures of the dollar versus the yen chart and the Nikkei almost every week, but I didn't start doing that actually until a little bit later on in the. I did it a little bit later on in the series because a few of the students asked if I could post those Nikkei charts so they could see that. Okay. So yes, there you go. There's that demand level that was too close to the supply, and of course it didn't work at all. It got traded through right away, and it was pushed through in just 2 days, and there were little buyers there, obviously, because it took 2 days to go through the area. But now we're working our way back down to the lower one at around 90.30. Okay. So which is leading or lagging, the dollar versus the yen or the Nikkei? Well, I'll tell you what. You have to chart them side by side. And as far as leading and lagging goes, the only time that you'll see the dollar rally and the Nikkei sell off is when the Nikkei comes into supply and the dollar doesn't, which means that the dollar has room to rally against the yen. So the only times I've noticed that there's been any kind of negative correlation in the pair and the Nikkei stock market is when they don't have opposing levels in about the same place. All right, so we're coming up on the end of September here. I'd like to get it through at least September, possibly move into a little bit of October. And that's going to be where we pick it up for number 5. So now the week of 9/25, we're still struggling to push through this weekly supply level. And we've been struggling to push through the supply level ever since it formed back in July. But what happened is we fell into that demand level between 98.30 and 97.80. And we had a monstrous rally out of the demand level the following day. So there's definitely some selling again. And usually if I look at the headlines, it'll probably be related to the news will be saying that the reason for the selling is turmoil in the world. It usually is. So what ended up happening that time was the Nikkei was up in a supply level as well. So this is a chart of the Nikkei 225 from 9/25, and it was having a hard time pushing through that supply level. And our dollar-yen pair came into that daily supply level. It fell through the demand level, which means that once this happens now, it'll open up its way for the next drop, which would be down to this 96.70 area. So in the first week of October, we're starting to fall away from the supply level again on the weekly chart. And on 10/2, we're having a pretty decent drop. And the Nikkei is also dropping from the supply level. And this time it was down 415 points on 10/2. Okay. So the Nikkei, because it came into demand, and this was daily demand, it actually started to bounce a little bit, and it'll kind of drag the dollar along with it when that happens. And of course, around the same time, we came down to that 96.70 demand level. And when we did, we turned around and we bounced out of there. Okay. So Boyke says, why do you choose to follow the yen out of all the currencies? Because at the time that I started doing the yen, I wrote an article for Traders Magazine in May of 2012, and I believed at the time that Japan was going to begin to stimulate their economy by printing a lot of yen. And so I was looking for the yen to have a pretty major sell-off, and I was looking for the dollar, because I live in the U.S. That's why I picked the dollar versus the yen to have a pretty major rally. But if you would have done this pair with the euro versus the yen, or if you would have done it with the pound versus the yen, you would have definitely had a a much bigger move in those currencies than the dollar did. Because remember, the dollar and the yen are both considered to be safe haven currencies at certain times. Or I should say, anybody that's short yen generally will cover their short yen position whenever there's turmoil in the world and put their money into the dollar. So this one really won't move as much as those other pairs will. But that's a good question. All right, folks, it's coming up again on the break of the webinar session. And as we get ready to end this session, we're ending it on September. We're in October now, and we're bouncing off of this demand level at 96.70. And at this point, I believe, is where the market started to make a move towards taking out the supply levels overhead. So this was about the last chance for anybody that wanted to buy a pullback to demand that was low on the curve to get a chance to do so. So we're going to pick it up starting with the week after the 9th. And the Nikkei also rallied by that time too. And that's one of those times where the dollar came into demand against the yen, and the Nikkei, which didn't have any demand, turned around and rallied with it. All right. So we're going to leave it here at 10.9. We're going to pick it up on 10.12. And when we do, we'll move into part 5, which, again, I'll try to get us as close to we can till we get to 2014, where we are right now. All right. So thanks a lot for everybody for participating. Thanks for the questions. I hope everybody had a good time. And I look forward to seeing you guys again sometime next month. And we'll pick up where we left off. Okay. And thank you, FX Street, for allowing me to be here too. So have a great day, everybody. Take care.